theme and talking about structuring financial renewable PPAs.
Yeah. So this talk will be a little bit different from the rest, because I'm not necessarily going to look at a system perspective, but rather trying to look at a deal in particular and trying to understand what's happening in the corporate PPA now. And basically we received a question that we started from a very basic pricing formula, and now basically the off-takers, the people that are signing those contracts, understand that there are some risks associated to that, and they want to change the pricing rule. And so basically we try to assess, okay, how does that lead in terms of the risk assessment? Can we still offer those corporate PPA at cheap price, and try to see how basically what could lead in terms of risk sharing between the two counterparties. Okay. So I guess the motivation of the talk is that, with respect to the renewable PPAs, so you had a lot of renewable PPAs, but they are actually contracted by government. But now basically you have also the rising of corporate PPAs. So basically bilateral deal between an off-taker, so usually a large industrial firm that actually wants to also procure renewable, that's going to sign those contracts, and basically that's the total capacity that has been expanding in the recent year. It started mainly in the US, but now actually we see more and more those deals coming also in Europe, and mainly in the same country for solar, and also for wind more in the another country. Okay. And so basically what we see is that now the off-takers, so those large firms, they start to realize that their profile of consumption is not fully correlated with the renewable production. And so basically that's where the risk starts to be. So they sign those contracts, but basically they realize that it's a very poor hedge for their own energy bill. And so basically there is a decorrelation between the off-taker energy expenditure and the renewable asset value. And so basically they want to assess, okay, how can we fix that? Can we not find other structuring deal so that basically they are better off, or that actually it's a better hedge for their own energy expenditure. Okay, so that's a little bit the context. So we've seen that the drop in renewable cost is really triggering a worldwide boom in renewable PPA, also as bilateral contract. And the market is evolving. We have more and more risk cannibalization, meaning that the renewables capture less and less the average spot profit. And so basically there's the time actually to develop novel type of structures with different risk sharing allocation. And so what I will present is a quick methodology in order to compute risk premium to be added, so that basically also the project developer can take some part of the merchant risk. And then I'll do a quantification for Germany and Spain to see, okay, what would it like if you were gonna change the contract structure. And so after we try to see, okay, what hedging or mitigation measure could be helpful in order to reduce the risk, both physically, maybe by having a balanced portfolio with different renewable technologies, or also with financial hedging, if you would be able to hedge it with traded contract. Okay, so in the first part of the talk I will show you what are those new PPA structures. Then I'll spend a little bit of time trying to see, okay, how can we value them, try to find the risk premium associated to it, some application, and then I'll conclude. Okay. So this was the traditional structure of the financial PPA. It has been very powerful also in emerging economies in order to secure investment. And basically it was an agreement between a project company that would build an asset, here renewables. And so basically that renewables would generate some profit on the spot market, but basically you had directly a swap. So that basically the project company could fully secure its investment, receiving a fixed price from the off-taker, and that actually it would transfer the spot revenue and the merchant revenue to the off-takers. Okay, and that actually it's kind of intriguing. I mean, when you look at levelized cost of electricity, okay, we know that there is a big part that actually we've seen capex decrease for renewable, but actually what's also interesting is to look at the debt ratio that usually have for renewable. And so basically that also explains in terms of LCOE how basically you can, you also had a drastic reduction in LCOE for renewable, because here when you look at the ratio, it's up to 80%, for example, here for non-trading PV. So basically that means that if you have that kind of fixed contract, it's quite easily for you to go to a private bank and being able to secure and to have a leverage up to 80% in order to secure your investment. Evidently, those kind of contract does not nullify all the risk for the project company, so there's still the construction risk, there's still the credit risk, the off-takers might go bankrupt, liability and so on. You have generation risk, also merchant risk after that bilateral contract period, and also something that actually, at least in the company where I am, is we are getting a little bit nervous and we really don't know how we would be able to assess future value of it. Those are imbalance charges, because usually those actually are not part of the deal. Okay, so this is very good in order to secure investment, but actually off-takers don't quite like that. Yeah. In this slide, so basically I'm trying to a little bit say, okay, what are the two different options or extreme when you would like to finance renewable? You could do it in a pure merchant-based setting, where basically you would only capture spot revenue, and this is basically what a traditional PPA do, is that basically you just transfer the spot revenue and you receive a fixed price. Okay, and so except of having an hourly revenue for your asset that actually is risky, you receive something that is fixed, times the generation, total generation, which is still risky, but still is something that is way less risky than the others. Okay. So now I'll present the new type of contract formula that where we start emerging in the PPA market. And so basically the off-takers actually, he didn't really like the swap, because basically the spot price, the merchant revenue that he was getting from the PV or the wind turbine install was really not a good hedge for his future consumption. So he'll not anymore ask to have here the spot price back to him, but he's gonna ask actually a smoother price, a floating price. And basically the way you could think it is that basically he would like to have a base load price, because maybe he has a base load consumption, so basically that would be a way better hedge than the renewable. Okay, and still this type of different swapping, basically you would still finance that through a PPA fixed price. And so basically what we are trying to assess is that, okay, what should be that PPA fixed price, how much should we increase it, so that basically this deal become interesting for that project company. And then we're basically, okay, saying, okay, what is the definition of this smooth floating price? Can we change it if we do it a settlement yearly, or maybe a settlement monthly, and so on? Does it change the risk? Does it change the risk premium? So this is a little bit the math around it. It's just to say that, okay, I will receive some fixed price PPA, I will collect the spot, the revenue in the spot market, but then what I will transfer to the off-taker is something a little bit smoother, where basically the settlement period is defined by here, the different capital T. So you could think about, okay, it could be also on a year level, but it could be also on a monthly level. And obviously, if you do it on the hourly level, then you're just back to the traditional fixed PPA structure. Okay, so our question was actually coming from project developers that actually wanted to have a valuation methodology out of it, and also trying to have a way where they could capture some portfolio effect and so on. So maybe before going to that, I think that it's important to try to raise, okay, what are the different type of risks that are that we are trying to see, and basically what are the long-term component and a short-term component, because that's also a question that was arising. Okay, we see that there is more and more renewable coming in the system. It creates some short-term risk, because okay, you're never sure if tomorrow it's going to be sunny or not, but it also creates some long-term risk, because you're not completely sure what's the policy target with respect to renewable will be, or you're not completely sure about the cost decrease and so on, and so basically you have two effects. So on the long-term risk and on the short-term risk, so basically on the fixed price PPA, so we are trying to look at what the correlation with respect to the price and the generation. Of course here there's no correlation, and the main risk that you have is the total value that you could generate. Okay, yeah, I mean it could somehow you still have a long-term risk that because maybe renewable curtailment of renewable might be a little bit more likely in the future, but still this risk is kind of small. Okay. Then you have the rest market revenue, and that's really where you have the most correlation between the market price and rest generation. And just by the merit order, clearly, if it's sunny, that means that all the PV panels are producing at the time, and so basically that's where the price drop. But of course, if it's not sunny, then basically you have to resort to thermal capacity. That's where the price jump, but basically you're not producing, so you're not capturing a lot of this price. And then when we look at rest market revenue, so I mean there is clearly the cannibalization effect. The more that you're gonna build renewable in the system, basically the market value tends to drop quickly, and specifically for solar, because you don't have many diversification between all the solar plants. And on the short-term risk, basically it's actually exacerbating this effect. Okay, and then there's something here, basically that we don't really know somehow. Okay, probably it's not as highly correlated as this thing, but still you would still have a correlation between the amount that you generated during a certain time period and also what was the average price in that period. Okay. So when we look at that, so basically our goal was to find a premium in order to cover the risk. So and what makes the problem a little bit interesting is that it was not just a fixed payment, because then basically you could assess that directly, trying to see what's the fixed payment that you should ask on top of it, but basically it had to be conditional on the value, on the generation that you would have during a particular moment. Okay. So basically now the payoff is risky, so you need a risk premium that we want to have a value in euro per megawatt hour, so that now I have here my total payoff function, which is the payoff that I just described. Then I had the risk premium times the generation, and basically I want to find the minimum risk premium such that basically the risk is acceptable for me. And here you can think about the risk measure being, okay, what's the capital requirement that you would need in order to have the risk that is acceptable for you, and basically you aim at 0. Okay. So so basically here what we are trying to do, then a little bit doing the math around that function, and basically you could see, okay, what's the risk given a certain risk measure, so that's what we compute, and working with a covariant risk measure, so basically we can use the dual representation of it and having an expression for that function. And using the axiom of covariant risk measures, basically you can quickly prove the following statement, that this function that actually, depending on the risk premium, you can prove easily that it's convex and decreasing, its ellipses continue, and basically that when the risk premium goes to infinity, it goes to minus infinity, and so basically and the opposite around. And given those properties, basically it's easy to show that basically this problem has a solution. So there exists a risk premium, so that actually I know that the deal would be acceptable for me. Okay. We spent with the project developers quite some time trying to see, okay, or convince him what type of good risk measure he should look at, because of course when you speak to those kind of things inside the company, they usually come to the VAR or to the standard deviation and so on. And so basically you spend some time educating them why the standard deviation is not a good metric, why the VAR is not a good metric, and so on, and that's what you did. And then basically when you spend time that, then they say, okay, but we should maybe then go to the finance department. Maybe they have the discount factor. And so that's usually when you do WACC discounting. And there also we try to say, yeah, you could go to the finance department, but then that means that they, I mean, using the capital asset pricing model, that means that they should actually know what the beta coefficient would be depending on the specific structure of the deal. And then you know that you would never get an answer for them. And so basically that's why we convince them that actually it's better to go more fundamentally in order to compute risk equity premium to do that based on convex risk measure. And here I'm also using the good deal, because actually here I'm really trying to compute an equity premium, and as it is based on a Sharpe ratio, it's something where in order to compute equity premium I can easily calibrate them. Okay. So when we looked also at the global problem, so you would say, okay, I mean, it's easy, you're just looking at the scala so that a function equal to 0. Actually, you can also, I mean, we try to do a little bit the math around it, and so, okay, for the CVAR, basically, you can state those problems as complementarity problem. They're not cast, they cannot be cast as optimization, but they can be cast as complementarity problem. And so basically here, what would it be is just the normal definition about the risk neutral probability of the CVAR, okay, that are bounded and so on, and this is basically the optimality condition out of it, and then on top of that what you ask is that basically you are also searching for the mu such that basically the value of the CVAR is equal to 0. And then for the good deal, basically it's kind of the same, except that the way that you're looking at the risk neutral probability here, you have a conic complementarity condition, but actually is kind of similar. Okay, so happily we know that those complementarity problems are monotone, and what we did in the paper is to try to develop efficient techniques to solve them. So it's still work in progress. I won't spend too much time on that, but basically, yeah. That was our goal. Okay. Yeah. For the rest of the talk, now I'll try to see. Okay, how those premiums looks like for different contract structure. Is it better to do a settlement every year? Does it have a lot of value trying to reduce the settlement period, maybe to quarter, to months, or to week, and then also trying to see what does it mean today? Are those premiums big, and what they could look like in the future when you start to have massive penetration of renewable? And I'll do that for Germany and Spain, and of course Germany will be interesting for wind, and Spain will be interesting for PV. Okay. So something that won't be a part here in the computation is that I removed actually everything related to the capital cost of the installation. And why I did that is not because I didn't want to, but basically it was a requirement for the client. He didn't want to have an eternal discussion about, okay, what's the capex and so on, so he just wanted to actually understand what's the value of the swap over there. I think that it simplifies drastically the analysis, because basically depending on the risk, I mean, it's not sure that, I mean, I keep somehow the same capital structure for my investment. I don't necessarily change what's the debt share and so on. And so I don't have that effect here. I'm just looking at the swap and trying to find a risk premium that actually covers this swap. Okay. And then also, I mean, we try to separate again this into different components, trying to see, okay, what's the value of long-term risk? Is this deal more risky because of the long-term risk that you have with respect to having more renewable in the system and cannibalizing more and more the merchant revenue? Is the short-term risk important? So what about all the, inside a year, all the viability that you have with respect to the renewable production? And then finally also what I call the generation risk, but I think that's it's a little bit misleading. It's actually, how can we compute the fact that basically we ask the risk premium to be multiplied by the total amount generated inside a year? Is this risk important or not? Okay, so I'll show you some brief yearly premiums and do some sensitivities, as I said, for Germany and Spain. Then I try to see, okay, what's the impact of the contract, the contract structure. I'll see some mitigation measure using some portfolio, and then trying to see is there a way to hedge those contracts financially or physically. All right. So this is what the risk premium looks like in euro per megawatt hour, and this is for wind, and this is for PV, and this is actually when you try to do the settlement every year. So basically you are exchanging a baseload contract with respect to the merchant revenue of the renewable asset, and you are asking what's the risk premium to cover the risk. So it's kind of low today. But then, of course, with the renewable penetration, you see that those risks actually, the risk premium that you should ask on top of the country, they are on top of the fixed price, they are becoming gigantic. Okay, and actually we see that also the fact that here PV cannibalize more than wind, and so that's why actually you should ask higher risk premium, and somehow you also see the interesting effect that it cannibalize even further in here Spain compared to Germany, and while here of course the wind is more risky than in Spain. Okay. Then we try to understand what's happening and what defines those risk premium, and is it a good idea actually to change the settlement period? So meaning that at which time for my special contract, basically I settle the time where basically I offer the average price over that period, and I looked at what's the generation during that period. Okay. So basically here is the solution where basically I have a contract written 100% on PV, and then I see a different settlement period. So this is yearly, quarterly, monthly, weekly, and daily. And so for PV, basically you see that it's mainly reduced when you go to quarter, but after that it stays quite flat, the risk premium that you are seeing. And that's kind of logic because it goes well with the seasonality of PV, where basically indeed you have a big seasonal effect, so winter compared to summer, and that's already embedded when you go basically to the quarter definition. But then the second big variation is within a day, and that actually is never captured by all those settlements. So basically to have another reduction of the risk premium, you should go to even a finer settlement period, but that actually was something that the project developers didn't really wanted to have as a contract offering. Okay. While for wind, basically the seasonality is different, and so basically you see that the risk premium is rather decreasing when you go on a weekly settlement and a daily settlement, and that goes actually quite well with the type of wind regime that you would have, so that basically wind with pro for a week or two, and that would be captured basically in those settlement periods. Okay. Yeah, this is the same for Spain, and so basically here the effect on PV was less dramatic because basically you have less seasonal difference in Spain compared to Germany, but still you had the same kind of effect for wind. Okay. So now basically, okay, we try to see, okay, what's the value of hedging? Can we actually make it our physical hedging, trying basically to reduce by maybe not only contracting PV, but also to have a balance share between PV and wind, and then after trying to hedge with trading commodities if they are available. And here basically I would assume that I have a base load feature that is liquid enough so that I can trade it. Okay. So those are the type of graph that we show during this project, is that basically there is a sense to have a mix in the technology, and there is a particular portfolio. So this basically shows what's the share of the wind inside the portfolio, meaning that 100% this is a fully wind-based PPA, and here 0% it's a full PV PPA, and so basically you have the wind share. And basically here what we show is that, okay, depending on what's the type structure that you have, so basically you have different optimal portfolio in order that reduce the risk. And basically they are actually, of course, country specific, but also quite interestingly, they are also depending on the type of deal that you are doing. So basically, in order to assess, there's no common rule or global finding that we could find here, and we said that it's important to assess the two together. Okay. Then we also had the case. I mean, battery is indeed a nice topic, and it's always a buzzword. But then basically, when we do the economical estimation of it, it's it's not often the case that basically those they prove to be useful. And here basically it will be the case. So basically here we are only looking at battery, but that actually will financial battery. So we won't have any side benefit of having the battery, for example. So that could be the case, for example, with depending on the retail contract, if transmission charge are there or not. So that can create economicity for the battery, but there actually we were only manipulating the battery on the spot price and basically trying to see if there is a counter effect with the merchant revenue of renewable. Okay, and so basically here we tried for different PPA, and here I'm not accounting for the capex of the battery neither, and so that's why basically you have a reduction of the premium of the total contract here, but because basically the battery is generating profit. But what's more interesting or more intriguing for us is that basically it didn't really reduce the short-term risk that I was assessing here. And so basically, okay, you could have think that maybe the battery is doing well when the renewable asset is doing bad. It's true, but somehow you also had a top risk of it, and the total effect of the two proved to be rather constant. Okay. And then the final part here is actually trying to see what hedging with respect to trading derivatives. And here I'll just take the most liquid contract, which is the baseload one, so a yearly future written of it. Obviously, when you try to secure the deal, you would like basically to be able to already hedge yourself by taking those positions. Of course, in reality, actually, when you look at those long-term contracts on per exchange, they quickly vanish. I mean, liquidity quickly vanish. You usually have good liquidity after a year, after 2 years, but then they are helpless if you want to secure your revenue for longer time periods. Okay, and so basically here, I didn't really know how the price of those hedge would look like, and so basically I just say, okay, suppose that I have a financial market and that actually price the risk goodly without any premium, and so I just take as a quotation price the expected payoff of that financial product. Okay. So what we find here is the reduction here in the short-term risk premium for the two cases. So in 2030, both our 100% PV PPA or 100% wind PPA, and that basically, I mean, depending on the contract structure, actually, we saw that there was indeed a positive value by hedging the risk. It was kind of difficult to make sense exactly on all those numbers. So again, here we could not really identify a clear strategy how you will hedge those contracts. Because it's a swap, and it's not sure that if you should go long or if you should go short on those in the financial contract. But basically, still we could achieve some reduction with respect to the risk premium. Okay, so I think that I'm about to conclude and to finish my talk here. So basically. What's the conclusion in this talk is that, okay, when you start to have other type of structure for the corporate renewable PPAs, basically you need to have an additional premium in order to take the risk. I mean, you should certainly do something. And here in this analysis, what we show is that, okay, right now maybe this premium is quite small, but basically if you expect I mean, if you need to cover a longer time period, then basically you should take quite high margin, because of course it's depending on the contract and the environment, but at least in Europe, where basically we more or less know that there's going to be more and more renewable and more cannibalization effect, basically you should actually already start to include that when you compute those corporate deal. Okay, and that basically was mostly driven by the cannibalization effect of renewable in currently. Okay. What I show also is that, okay, this short-term risk can be minimized by having some type of portfolio, by trading baseload futures on the exchange. And another conclusion was that the battery is not really helpful for those contracts, at least given their current capex. What is not in this talk, and something that I would like to expand on, is actually how the change of the contract formula actually could change the debt to equity ratio. So that could probably do by embedding that with other type of risk measure that would try to capture, okay, how a bank would react when you're going to change your contract formula. Would it allow you still to take 80% of debt and leverage it? Probably not. Is there a way to quantify that? So that's certainly subject for future research. I think that more broadly, what I take from this is that more fundamentally, actually, it shows that margin risk of renewable is important, and it's not vanishing. And basically, it's mainly there because, okay, you have long-term uncertainty of renewable cannibalization effect. And so basically the natural question is that actually who's the natural counterparty to take that risk? It's true that in auctions that are driven by the states, then all that risk basically is transferred to the state, but can we not find a more natural counterparty without necessarily passing that through to the government? Actually, can we also not design long-term contract in order to hedge this risk? So basically it's not necessarily the normal base load price risk that you would like, because the off-taker would like to take them because it's a good hedge regarding to the consumption. It's rather the providing cost and the fact that renewable capture another price than their consumption. And then I guess on the market design side, okay, how can we design those long-term contracts? Can we ensure liquidity and so on? I don't have the answer to this question, but I think that they are interesting. Okay, thank you very much.
Plenty of time for questions, but before that we have Stein Erik. He's going to provide a simple question for you.
Thanks, Gauthier. Very interesting talk. A practical application of very important instruments to build these new renewable plants. Renewable plants are typically located, wind plants, they want the best wind sites, and solar in Spain, and hydro in the Alps and in Norway, etc. So there's significant locational rents. So if you have a very good site, then you are much better off. Yes, this is kind of the background for the question. So how is the PPA contract price, PPA bar set? Is it market-based? And you can imagine that the market has an effect on it. What are the considerations? Obviously, the analysts that help here would be interested in having forecast, long-term forecast with the spot price and things like that. Maybe you can comment on this.
Yeah. So what can I answer there is that basically on the project development side for the moment they used to just transfer the risk, and so basically they didn't really see now those rent, and so basically when they were pricing they were just doing cost-based, trying to see how much they could how much they could purchase the asset, what was the construction cost. So it was really kind of cost-based, trying then to go to a development bank, trying to have a good a good debt ratio, and then just asking that in the traditional structure. It's true that now that basically this contract also allows you to then capture part of that market revenue. And so basically, indeed, maybe there's another effect where basically that should also come into account. I wonder if in that particular case it's not captured by our risk premium, because basically we are looking at plant specific what you capture and so on. So yeah, I don't really know. I mean, it's clearly not yet in the mind of the project developer that are mainly now doing it on a cost basis. I think that we capture a little bit of the rent effect by trying to have an asset, a precise asset, what you would gain on margin revenue. But then there's probably more long-term effects, meaning that okay, if you have a good wind location, probably you want to have it for longer term and so on, and that might change also your valuation.
Any questions? Go on.
I'm just wondering, Gauthier, is it possible that demand response could play a role here in terms of the counterparty?
Yeah, I think that What could certainly help is that basically if you know that you have a consumption profile, that basically here what you want to deliver is basically a baseload profile cost. And basically if you can already play with respect to that profile and make it match a little bit better the profile of the renewable, basically you could drop quite dramatically the risk premium that you would have here. So that could be or on on the off-taker side, on the industrial consumer, or on the project company, where basically maybe with demand response, by investing into it, he can make it a little bit smoother and maybe also ask less risk premium for the deal. Yeah.
Any other questions? Everyone's keen to get to lunch, so thank you very much. Gauthier, very nice talk.